Unit 12, the secondary mortgage market. This is where money is redistributed to make home loans available to consumers. The secondary mortgage market has nothing to do with second trust deeds or equity lines or second home loans. Um, the originators of new home loans are called primary lenders. And then later on, most loans created by the primary lenders are sold into the secondary market. Lenders acquire money for new home loans, avoid the risk of holding long-term fixed interest rate loans. What happens basically is say you have a large lender who has $500 million of capital to lend for home loans. Well, during the course of the year, they're going to lend all of that money out. So they're going to have to find a way to come back and get some additional money to lend out to more customers that want to buy home loans. So what they'll do is they'll sell those loans into the secondary mortgage market. More often than not, they'll put together a mortgage-backed security or pool of loans and then sell them into the secondary mortgage market. Now they have more capital and money to lend out to other homeowners that want to go out and mortgage. The regulator in the secondary mortgage market is the Federal Housing Finance Agency, or FHFA. They regulate Fannie Mae, Freddie Mac, and the Federal Home Loan Bank. Fannie Mae and Freddie Mac are GSEs, government-sponsored enterprises, and what they do is they purchase loans in the secondary mortgage market. The sole purpose of the FHFA is to restore confidence in Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac, these two GSEs, are basically called will purchase conforming loans, and a conforming loan sets some standards that they'll purchase the loans at. If they're outside of those standards, then they're called non-conforming loans, and they won't purchase them. One of the first things they do is they'll set the maximum mortgage loan amounts that they'll purchase. They're not listed here, but I have them on another slide. And their maximum loan amounts for a single family, a duplex, a triplex, and a fourplex. Fannie Mae and Freddie Mac will only lend on 1 to 4 unit properties. They'll also set the loan to values. The loan to values can be from 3% down, 5% down, 10% down, and so on. Anything less than 20% down has to have mortgage insurance. One of the benefits of Fannie Mae and Freddie Mac too is they'll allow a gift from a family member for down payment and closing costs for somebody that wants to purchase a house. Fannie Mae and Freddie Mac will also set qualifying guidelines also. So they'll set debt to income ratios for the principal and interest, taxes and insurance, or the house payment, and also the total monthly expenses. And what they like to see is that the debt to income ratio for the new housing payment, principal, interest, taxes, insurance, does not exceed 28% of the person's gross monthly income. For all their bills, principal and interest, taxes, insurance, that new payment plus car payments, MasterCharge, Visa, and other monthly loans, they don't like it to exceed 36%. Now I'm going to qualify that too, because today, and we'll talk about this later, Fannie Mae and Freddie Mac both have electronic underwriting systems where if you put the borrower's information into their system regarding their debts and also their income, and the underwriting system approves that loan, they could go as high as a 43%. What Fannie and Freddie will also allow too is that a seller can contribute up to 3% of the sales price as a credit as long as the down payment is 5% or greater, 6% if it's over 10%. They'll allow fixed rate and adjustable rate mortgages for people that are truly first-time borrowers with a minimum down payment, say like that 3%. They will require a home buyer's education course before they'll lend to them. Once again, conforming loans, somebody could put 3% down, and that would leave them with a 95 or 97% loan to value, or 5% down, so a 95% loan to value, all the way up to 20%. Once again, anything less than 20% down then you do require mortgage insurance. Gifts can come from family members. Most often today, if somebody's getting a conforming loan, they're probably going to get a 30-year fixed. But you can get other terms on those loans too, the fixed rates, whether it be a 20-year, a 15-year, a 10-year. But most often when I've seen conforming loans, it's 30-year fixed. Fannie and Freddie do have adjustable rate mortgages. They could be a 5-1, 7-1, or 10-1 ARM. What happens in those is, say in a 10-1 ARM, the initial start period is set for 10 years, and then after the 10th year, the loan would adjust based upon the lender's index plus a margin. So the index is the lender's cost of funds plus a margin cut to come up with a new interest rate. One of the things that Fannie and Freddie allow for also is if a buyer would like to avoid mortgage insurance, they'll allow for a second trust deed to be used to lower the loan to value and thus avoid mortgage insurance. In this example I have right here is an 80-10-10. So the ultimate goal you're trying to get down to is an 80% loan to value so you avoid mortgage insurance. And you can do that in this way. Buyer puts 10% down, the seller carries a 10% second trust deed, or the buyer may go out and find another second trust deed and come in. But ultimately, you have an 80-10-10 or an 80% loan to value, so no need for mortgage insurance, and Fannie and Freddie will allow for that. Fannie Mae was actually established in 1938, 4 years after FHA started, and initially they purchased FHA loans. Fannie Mae can purchase or sell in open market transactions a pool of loans or a mortgage-backed security, and they can administer the price. Some of the terms here is say they're buying, or I'm just going to use a small example. Say there's a loan out there or a group of loans that are in the $500,000 range, and par is 100. So if somebody wanted to sell that loan at par, they would get their 500,000 back. But sometimes in the secondary market, you could sell at a premium and say that the premium was 101 or 101% of what your loan amount is of the 500,000. If it sells at a premium, then you're going to sell at a profit. So at a $500,000 loan, it would sell at a premium 101. You would receive 505,000 back. And once again, normally in today's market, they're selling mortgage-backed securities, which are pools of loans, and they can include Fannie Mae loans, conforming loans, Freddie Mac, and FHA. The maximum loan limits change on an annual basis. So in this case, 2020, for a Fannie Mae, Freddie Mac, or FHA loan, for a single family residence or a single condo, the maximum loan they'll purchase is $701,500. Anything over that, then it's non-conforming and they won't purchase it. For a duplex, it's $898,050. For a triplex, $1,085,550. And for a fourplex, it's $1,349,050. And that's what it is for 2020. January, they come out with new loan limits. Fannie Mae and Freddie Mac both have their own automated underwriting systems for their conforming loans. And actually, non-conforming lenders will generally use one of these systems to underwrite their files also, even though with that approval they can't sell to Fannie Mae and Freddie Mac. But what they're looking for is the information in that electronic file about their income, assets, credit, and see if it conforms to what they're lending at. So what they're looking for in the systems, of course, is the loan limit and the guidelines that they're looking to conform to. Then the automated underwriting system for Fannie Mae is called Desktop Originator. Actually, it's Desktop Underwriter, DU. Freddie Mac is called Loan Prospector, LP. And all of these are really contingent upon credit scoring. So in regards to credit scoring, there's two things. It really helps you get approved through DU or LP, and it also helps in pricing. If a person has a good credit score, say if they're above 720 on a credit, they'll get better pricing. The lower your credit score or the lower your credit rating, the worse pricing you'll get in your interest rate. Freddie Mac was provided to provide secondary mortgage market lending institutions that were members of the Federal Home Loan Bank Board system. So those members use Freddie Mac. And generally, when you're talking conforming loans, it's interchangeable. Fannie Mae and Freddie Mac are almost the same as far as their underwriting guidelines and programs that people find. Ginnie Mae is very similar, another GSE that purchases loans on the secondary market. And what they want to do is expand affordability to other areas, to underserved areas around the United States, to provide lending capital for people trying to purchase homes. And once again, they'll buy mortgage-backed securities, often called pass-through securities. And mainly with Ginnie Mae, they're purchasing government loans, meaning FHA insured loans and VA guaranteed loans.